We're not positing as free banking merely what we like. That is not what free banking is. Free banking is our best guess at what a free market banking system would have looked like if the government had stayed out of it all along.
In our modern world, money is undergoing a technological revolution. Bitcoin and cryptocurrency threaten the status quo, while governments and central banks are imagining their own hyper-centralized CBDCs, an imminent threat to personal and economic freedom. In the middle of all of this, pro-liberty academics, entrepreneurs, and Bitcoiners are having heated debates about the nature of the banking system, its flaws, and its history. In this episode of Liberty Curious, I sat down with free banking proponent George Selgin, Senior Fellow and Director Emeritus of the Center for Monetary and Financial Alternatives at the Cato Institute. We discuss the history of money and how it is not new for governments to abuse or mismanage it. We explore the different opinions around money and fractional reserve banking and what a Bitcoin standard might actually look like.
Anyway, let's talk about pleasant stuff like fractional reserve.
Yeah, let's talk about money. Let's talk about banking. Let's talk about all of these debates that have been going on around this stuff. I find it really fascinating because I look, George, and I see that there's all of these, let's call them freedom people, and people who study the banking system or who are, innovators or entrepreneurs in the space who believe in monetary or economic freedom. But then there's some division among those people, largely having to do with Bitcoin, fractional reserve banking, free banking, what the history of the banking system look like, and what the future of the banking system will or should look like. So it's just, there's a lot in there.
Indeed. And I think it's really important to distinguish, and some of these people you're talking about don't do it adequately, in my opinion. Distinguish between statements about what has been true in the past and conjectures about what might be true in the future. Now, such conjectures are, of course, open-ended in the sense that you can't say they're wrong. They could be right, and I don't say that they're wrong. If somebody wants to make a prediction about Bitcoin taking over the world, I might say I don't think it's likely. And I have said that. At least I don't think it's likely to displace the dollar and that sort of thing. But I don't pretend to know that it can. When I make statements about the past, I'm not implying anything about the future. I'm just saying what was what. And I find a common habit among my critics or opponents in these discussions about Bitcoin is that of taking my statements about the past and kind of twisting them or twisting the discussion as if it were about the future. So I'll say, look, there's never been anything fractional reserve banking has always been the popular choice in the past. And they'll say, but in the future, that's not going to be true. I say, okay, well, that's okay. That might be true, but it has nothing to do with my statement.
Right. And that's actually something that I've been thinking about with Bitcoin, particularly because if I understand correctly, it is a different system than anything that's existed before.
Yes, it is.
Can you explain how? Like, how do you see it being different than what you've studied?
Well, I actually wrote a piece about this when Bitcoin was still pretty new, where I pointed to the distinct characteristics of Bitcoin by way of saying that it didn't qualify exactly as either a kind of private fiat money or a commodity money in the usual sense, like gold or silver or cowrie shells, and that's because it shares some features of each. It's not a natural commodity, of course. It's not a commodity in the sense of having any uses other than as a financial asset. You can't eat it, you can't wear it, you can't, guilds cover building cupolas with it and that sort of thing. On the other, and it's not something that's naturally scarce. There's no such thing as a natural source of it, and there's only so much there. Like, I don't know, coal. Or gold. It is something that's artificial, like fiat money. It's been created like fiat money. It's only a financial asset, like fiat money, but it's scarce. It's scarce in an inevitable way, kind of like gold. We know that no one can make more than 21 million units of the stuff, or even that many ever. We even know how rapidly it's going to produce and where it's going to be produced and when it'll reach that limit. But we also know that the limit can't be changed. At least it's very difficult to change it. So it has that characteristic in common with gold, but it also has in common with fiat money the fact that it's artificial, the fact that there is no non-monetary use, the fact that changes in non-monetary demand for the stuff, by which I mean demand for it is something other than a financial asset, demand for it to wear or to gild buildings with. Those things are not relevant, and that's good. That's an advantage in some respects. So it's a new kind of thing, for sure, new kind of thing. And I also wrote in that article, for what it's worth, that its newness means that it could potentially have qualities that are better than anything we've had in the past. Or if Bitcoin couldn't have exactly those qualities, something like it could. We could imagine a different algorithm, but the same in spirit to that of Bitcoin, that gives us something where the supply behavior is a little more sophisticated. It's not absolutely going to come to a certain number and then stop, but could change, could grow steadily over time. There's all kinds of possibilities that could be programmed to a different synthetic commodity, which is what I call Bitcoin. To make a different synthetic commodity that has advantages even over Bitcoin.
And do you see cryptocurrency as being a non-synthetic commodity as well? Like, do you think that cryptocurrency could?
This gets into semantics, but if cryptocurrency means something like Bitcoin, where there's no convertibility into something else, there's no link to something else, there's no redeemability, then yeah, they're all synthetic commodities. Ethereum's a synthetic commodity too, but a stable coin is not a synthetic commodity.
Because they're
pegged. A stable coin is pegged, and at least some of them are pegged through redeemability of some sort, and those are really more like today's bank monies. They're IOUs. So those are not synthetic commodities. They're not potential basic monies or standard monies. A Bitcoin is.
I've actually spoken about that in depth with Thomas Hogan, about how stablecoins are kind of like banknotes, essentially.
That's right. They're like banknotes, with the important difference that almost all of them that I'm aware of that are redeemable at all put some considerable constraints on redeemability. So unlike an old-fashioned banknote, you couldn't go with let's say a £5 Bank of England note. You could go to your bank and say, "Here, give me some coins." With small amounts of a lot of these stable coins, you're out of luck, and you may face some barriers even exchanging large amounts of them. And in some cases, and I don't think this is necessarily a bad thing. In fact, under some circumstances, it can make sense. In some cases, the issuers reserve the right to contractually suspend redemptions and have done so. So all of
Oh,
these things should be taken into account. Yeah,
right,
the
right. So,
durability in these systems is not complete. It's not always cheap. It's not absolute.
and there's also a lot of heat on them from regulators, right? And we've seen that. I don't know if you've read about Operation Chokepoint 2.0. What do you think of that?
Well, um, there are there are all kinds of reasons, good and bad, why regulators uh, are really giving stablecoin issuers a hard time. Everything from their concern that uh, they offer ways for people to get around the know your customer and anti-money laundering laws that banks are supposed to abide by.
Hmm.
There's fear that the failure of these issuers can have contagion effects that adversely affect other financial institutions, including banks. There are all kinds of concerns. And as I say, I think some of them are misguided. Some of them may not be. Of course, it all depends on what you think about money
Right.
laundering laws, for example. But there's certainly, I think, reason to suspect that panic is actually informing a lot of the attitudes today of regulatory authorities towards stablecoins, that they're overreacting. And instead of seeing how by providing for stablecoins, especially by allowing their issuers to a greater ability to participate in the established payment networks, to be part of those networks, and regulating them accordingly. By preventing that, the authorities are actually making it harder for truly stable coins to be established. The most obvious example of this is that clearly, as many critics of banking maintain, and quite correctly, nothing is safer than to have an IOU that's 100% backed by the stuff it promises to pay. We all agree that that's the safest. It's not always the most economical or best arrangement, but it's certainly the safest. Well, the only way a stable coin issuer can do that now, have 100% reserves, would be if it held actual Federal Reserve notes, in a big vault somewhere, which is, by the way, itself not exactly safe. It actually involves the risk of theft. Because the Federal Reserve won't allow stablecoin issuers to have access to reserve accounts with it, which are the way banks keep most of their reserves and do so pretty safely. They have credit balances at the Fed. And so as long as the Fed doesn't go broke somehow, I can't see how that would happen, even though it can lose money hand over fist, the reserve balances are the way to go if you really want 100% reserves and the safety that goes with it. And yet the Fed regulators are saying, essentially they're saying, we don't want to allow stablecoin issuers to become part of our payments system and to participate in it directly like banks because they're too dangerous. They're saying that, and then they're also, by saying that, they're saying we're not going to let them become less dangerous by making it easy for them to have 100% reserve. We're not even going to make having 100%. We're not even going to let them have reserve accounts on the condition that they maintain 100% reserve. When they
Right. And that
rejected, yeah.
Custodia, right, is what you're talking
When they
about.
rejected Custodia's account, this was essentially the arguments they made. Oh, they're dangerous because they're dangerous, and therefore we don't want to give them reserve accounts. And they say in their response to Custodia, they say, oh, Custodia is actually going to be dangerous because if we give them the ability to maintain 100% reserves. Why? because then they'll have to earn money other ways, right? They can't earn it. They'll earn some interest. They might earn interest on the balance. That would be up to the Fed too, right? But that if they don't make enough interest, if their plan to operate on the basis of 100% reserve somehow makes them have to undertake other activities, why then that could be dangerous. We're not sure they're able to do it. We're not sure that they're going to be profitable. So you can't win for losing, right? Hold 100% reserves. If you say you're not going to have 100% reserves, then you're too dangerous. If you say, oh, okay, we're going to have 100% reserves, then, well, you might not be profitable. Therefore, you're not going to succeed. Therefore, you're going to be too dangerous. And one way or the other, you're going to be too dangerous.
Right.
It's a disgusting document. I'll come out right out and say, yes, I'm a Fed critic, but I don't call everything they do disgusting. There are arguments dismissing Custodia, justifying their rejection of Custodia's master account application. That is a disgusting document, and I urge anyone who thinks otherwise to take a good critical look at it, because it's truly, it defines what one means by lawyers' arguments when that expression is used pejoratively. This is a great example.
So what's happening here then, George, is that basically, like how I see it, is that it looks like they just don't want the competition. It doesn't look like it's something that's just purely out of fear, where they're just afraid that these things will fail, but they're using this as an excuse because they don't want to have to compete with that. Because I know Custodia as well would be involved in Bitcoin and things like that. And I think that perhaps they see that as the biggest competition, right?
I think that there are all kinds of things involved. I actually don't think that fear that these things will compete with the Fed itself is a big factor, though it may be part of the story. I'm pretty sure fear that these things will compete with ordinary banks, who are the Fed's constituents. I think that's probably more important. And finally, I do think fear is part of it. Bureaucrats are scaredy cats. There are good theories that explain why, given two possible types of errors they can commit, the error of allowing something that then goes bad, and the error of not allowing something that could go very well, that could be a good thing. They almost always prefer to avoid the first error, because it's more conspicuous when they fail the other that way. That is, whenever things go wrong, if people can blame a regulator for having allowed it, and of course they generally can, they do. Whereas regulators seldom get in trouble for prohibiting things, or they get in less trouble than they would if they allow something to happen and then it goes south. So that's a very typical bureaucratic reaction. And I think it obviously does have something to do with fear. They fear the repercussions of not preventing or prohibiting something that then ends up causing trouble.
And what are the kinds of repercussions that regulators can actually face, like in the real world? What does it look like?
Well, that's a great question, because the plain truth of the matter is that the repercussions they face are pretty meager. That is, unlike the repercussions a private businessman faces when he or she makes a mistake that can include, losing your whole investment. Obviously, the Fed people don't have that kind of skin in the game. They only have to worry about the opprobrium that'll be heaped on them if they make a mistake. But this seems to be enough. It's kind of like what Kissinger said about academic politics. He said people take strong positions because the stakes are so low. And I think that's something like that is going on here as well. Bureaucrats are very afraid to be caught not regulating something that then turns out to cause trouble. And we see this in the FDA. It's all about prohibiting drugs unless they are absolutely convinced that they're safe. regardless of what their potential benefits could be. I think this is just a very common reaction. And let's face it, it's very low costs, right? So if you say, well, the costs of bureaucrats making one kind of error rather than the other, the cost of them doing so isn't really that great. And you're right. But the cost of them not making, the cost of them, the cost of them doing what they do, which is prohibiting things even when they could be really desirable, that cost is even smaller to them. That's the point. And the decisions these bureaucrats make aren't based on the absolute costs they face from doing A instead of B, but only on the relative costs. And they're going to choose the thing that has the relatively smaller cost to them. And that's what's going on.
Wow, it's pretty crazy. So, I mean, that's the thing, is that in looking in this whole big picture of what's going on with the economy, with the bank failures, with the regulators, with some people decrying fractional reserve banking, with other people saying, no, fractional reserve is not the problem. Like it's all basically that you have people at the end of the day who are calling these shots who, as you say, don't have skin in the game, right? And so it just kind of continues in the way that it's going, despite all of the kind of arguments that are happening. So what do you think is going to happen moving forward with all of these things, with the stable coins, with Custodia? Do you think that they're going to, with Bitcoin too, like what do you think is going to be permissible according to the regulators in the future?
Well, I'm afraid that the Fed has, with its Custodia and some other decisions, I think the Fed has made its position very clear, and not just towards Custodia. I think Custodia is really just meant to be
An example,
a warning, example. Yeah, pour encourager les autres, as they said about Admiral Byng. The idea is to let everybody know that they are not planning to let stable coins and other kinds of cryptocurrency mingle with the established payment system or parts of or extensions to it that are official, like FedNow. They are not going to let these things commingle. They are going to treat stable coins and their issuers, even when they get bank charters, as persona non grata in the regular payment system. That's what they have basically told us. So they, on the one hand, they paid a lot of lip service to developing guidelines and how they were going to deal with investor account applicants fairly and squarely. But now they've let the cat out of the bag and basically said, if you have anything to do with stable coins or cryptocurrency, forget about it. That's what their decision means. And I'm afraid, therefore, that I think the prognosis for real progress here, which in my opinion, and I know a lot of cryptocurrency people disagree with this, but particularly when it comes to stable coins and US dollar stable coins, these things are only going to be able to work safely and efficiently if they can be part of the established payment system. That is, if they can be connected to it. And if the issuers or the issuers' banks can be connected to that system.
So here you're talking about stablecoin, though, not Bitcoin. I want to just differentiate there.
No, Bitcoin is not dependent on it. But what the problem that Bitcoin faces here is that all the exchanges and things that might benefit from having access to the dollar payment system are struggling. Of course, this is also part of what Custodia meant to do. And so basically they're not letting any links exist that could even make it just to make it easier to buy and sell Bitcoin, for example. Of course, Bitcoin can survive without these links, and it won't suffer in the way that US dollar stable coins will suffer from their absence. That's right. Bitcoin will survive. Stable coins may also survive, as they've done so far, but this puts a real limit on how effective they can be as alternative exchange media to bank issued stuff, let alone to the stuff issued by the Federal Reserve itself. So if we're talking about private substitutes for US dollars, banks clearly are being given an advantage, and particularly banks that don't have anything to do with stablecoins, and stablecoin issuers are being put at a disadvantage. This is an entry barrier. It's a government entry barrier. There's no other way to describe it.
So as you've said about not having a crystal ball, basically, not being able to see exactly what will happen in the future. Of course, we can't know, but you've studied the banking system and its history going way back, in different countries as well. And so are there other examples of times when regulators have made it impossible for certain technologies or competing monies to take hold?
Oh, sure, all the time. Give the most obvious, obviously analogous example, governments have snuffed out private issuers of circulating paper money, and have, in this case, they haven't favored the banks. They put up barriers to the banks' ability to compete with their central banks. And so the central banks have been giving an outright monopoly of paper currency, which sadly most economists assume is a good thing, because they don't know the history very well, to be frank, and or they only know the U.S. history badly, and the result is that we've had for a very long time now, depending on which country you're concerned with, you have not had any real financial innovation with paper currency or the private development of substitutes. I think that if the banks were still issuing their own paper currency, or were still allowed to, some time ago we would have seen electronic substitutes for this stuff. But the same statutes that took banks out of the paper currency business, I think, were read as eliminated their incentive to innovate in that area. You can't really innovate when you don't have a product anymore to begin with to innovate from. And so what happened is that stablecoins came, as it were, from outside the banking system as a new technology that might have been developed within it if it hadn't been for the history, right? Because technology doesn't belong to any specific industry. But in this case, it was outsiders who said, "Oh, we see an opportunity here that banks have kind of given up on. Let's see what happens if we try to do it in their place." And ultimately, these issuers have found that they too could use some integration with the banking system. Anyway, so paper currency is a historic example. Coinage was the earliest, right? Governments very quickly, with rare exceptions, monopolized the production of coins. And anyone who thinks they did it because the private sector couldn't make little round discs that were uniform and reliable is a fool. Unfortunately, the scholarship in this area is full of fools on the subject. In fact, of course, as your audience will probably understand, the reason why governments since ancient times monopolized coinage is because there were fiscal advantages to doing so. It was precisely because occasionally they could then debase the coins,
right,
and abuse their power of coinage, their monopolies, to do just what the dumb economists think they were trying to prevent the private sector coiners from doing. And we know from the rare episodes of competitive private coinage that the tendency in those cases was the opposite. It was that the best private coiners would survive, the most reliable ones, and the other ones would go out of business, just like people who make, just like people who make safety pins and screws and nuts. A company that produces a screw that doesn't meet any of the existing standards is not going to stay in business very long. We're going to make our screws a little smaller to save money. It doesn't work that way. But when the government does it, it's tant pis. People just have to put up with it.
They can decide they can decide that they are going to make screws how they want.
Yeah, or whatever. So the usual. This is so mundane, but it has to be said. The usual arguments about the advantages of competition all apply perfectly. There's no problem as to why they shouldn't fit for coining. There's none. Mm-hmm. But economists have managed to convince themselves that coinage should be a government monopoly, and that the private sector couldn't do it well. And I'm afraid that this reflects something that I now feel very strongly about. And the economics profession is full of people who devote their efforts to just rationalizing whatever it is that exists, instead of thinking critically about it and asking whether there's really any good reason for it. And you see this all the time. For whatever reason, I've never been bothered by the fact that people do X, the governments do X, into feeling compelled. I've never felt compelled to assume that because the governments have done something for a long, long time, that means that it can't be done any other way. And I just wish more of my fellow economists were open-minded about these things. Some conventions are conventions for bad reason.
And do you think that this is just because of the way that Keynesian economics took over, that people are very influenced by that? No,
it has nothing to do with Keynes. Keynes has become a silly kind of a popular whipping boy for libertarians and conservatives. They don't know what Keynes. Most of them have no idea what Keynesian economics is, where it came from, how different it is than other stuff, and instead they just Keynesian is just it's a word of opprobrium. It's a synonym for I don't like it, for something that the people don't like, and and it's silly for all kinds of reasons. One is that the most fundamental claim of Keynesian economics, which is that occasionally things go bad because people aren't spending enough, one way or the other, is true. It does happen. Investment collapses, could be consumption, but it's usually investment, and can collapse for all kinds of reasons. The government can be to blame. Central banks can be to blame. It often has to do with the failure of the banking system, because what a banking system is supposed to do is convert our desire to save with it into a corresponding loan making, right? So if I'm trying to accumulate deposits at my bank, and others are too, and nobody's trying to decumulate, that triggers or should trigger the corresponding growth in lending by the banking system. What that means is, as I cease to spend money, somebody else will spend in my place, and the total flow of money to the economy will be maintained. What Keynes argued, and he wasn't, by the way, this wasn't original, particularly, though he succeeded in getting more attention to it than others had, was that when this happened, steps have to be taken. The government have to make, or the central bank, or if it has one, and by then most countries did, has to take steps to fix the problem. And I would argue, and others of the free banking persuasion would argue, that when you have a good private banking system in the first place, instead of relying on central banks, why, that's just exactly what it tends to do. It tends to make sure that, that the banks tend to lend more when people try to save more, and it usually works okay. Anyway, the argument that there's a case that it's possible that too little spending will cause trouble, and that something has to be done, and that governments may have to do it to get the spending back up. That's the kind of central argument of Keynesian policy. We could argue about how they think spending should be revived, fiscal versus monetary policy and all that. But the fundamental claims are, there's nothing wrong with them. And they're not original with Keynes. If you go back before 1936, when Keynes wrote the general theory, you find in the United States and elsewhere plenty of other people who more or less argued the same thing. By 1936, it was actually kind of old hat to claim that depressions or recessions are caused by people not spending enough, and that fiscal or other policies are needed to revive spending. So there's more to Keynesian economics than that, of course. And I'm not saying that all of it is uncontroversial or fine or whatever. I am saying that this kind of kernel of it is not something that people should be going out of their way to condemn.
Yeah, well, I mean, it makes sense for me that people would give it a bad rap in general, because they're kind of looking for a blanket way to kind of explain what they don't like, And I think that the source of that is thinking like, like it is control, really. Like people, I think when they're pushing back against Keynesianism, that's what they mean, I think.
Yeah. Well, Keynes didn't invent bad government policies.
Right.
In the realm of money, those policies, as we were saying before, they go way, way back. So it didn't take Keynes to inspire governments to abuse money or to mismanage it. And the advice he did give, as I said, at least some of it, wasn't particularly bad. Some of his arguments were bad. Gold standard people will, of course, dislike Keynes because he didn't like the gold standard. He was definitely constructivist. He envisioned managed paper money, saw it as ideal, tended to downplay the dangers of abuse of managed fiat standards, and that was naive. Like a lot of let's say liberal interventionists, he tended to assume that smart people like him would be in charge and would see to it that everything was done right, and didn't really worry too much about the possible abuses that could take place. So I'm not trying to defend everything that Keynes argued, but I am saying that treating him as a bogeyman, as a kind of symbol of everything that's wrong about economics or government is silly, and certainly it's a mistake to imagine that it was only when Keynes came around that we started to have
it's a human
really
tendency.
bad government policy.
Yeah, that's right. I mean, so it just seems to be like that's what people look towards as a term to just kind of talk about what they don't like, as I said. But I mean, this traces back and back and back and back and back. Like it's human tendency to want to have these accumulations of power, to have good intentions, and then to abuse that power, all of that kind of thing.
It's people like to be able to, summarize their likes and dislikes with a single word, or in this case, a single person's name. On the left, you say capitalism, and what you mean is some coherent thing that we all can understand the meaning of. You mean all the things about life that you don't like, and you call it that. And in the same way, some conservative and libertarian people, all the things they don't like about what governments do in the way of economic policy, they call Keynesianism. Right. It's just a name, but it's inaccurate. And capitalism, well, maybe or maybe not. The pejorative use of capitalism is correct if you define capitalism explicitly as all the things you don't like, and then okay. But if you include the free market, or want to confuse people, but want to make people really are referring to the free market, then you got to start clarifying that.
What you mean? Yeah.
Yeah. So these terms, it's perfectly okay to criticize Keynesian economics if that's really what you're criticizing. It isn't
Right.
okay to criticize it if you're just using Keynesian economics as a name or covering term for a whole bunch of things, some of which have to do with Keynes and many of which don't.
Yes. No, that makes sense. And I mean, I think that you brought a good example of capitalism as well. It's that people either don't have the full definition or they have a different definition for it. And it's really just kind of the things that they don't like, but they don't necessarily have a better way of describing it. But you brought up free markets there. And I just thought of a question that I had wanted to ask you before we even got on here if I had a chance. And so I think this is a good opening for it. So you've studied the banking system, the history of the banking system. You're a proponent of free banking. And you point to the Scottish system and in some instances the Canadian system from hundreds of years ago as being kind of good examples of free banking, though not perfect. But my question is, have we ever seen an actual free market anywhere?
In banking or generally?
Yeah, in banking and generally. And maybe you can distinguish between the two.
No, all these things are what Max Weber called ideal types, right? You have an ideal type. We can contemplate the thing even if we don't ever see a perfect example of it. And in most of life, there are no perfect examples of anything. You pick a rose, it's probably got a flaw in it. But we can conceive of a perfect rose. Why not? And in the case of economists, deal in ideal types all the time because they have to, because the perfect specimens are just not out there. And so when they talk about competition, they have an ideal type in mind. When they talk about free trade, it's an ideal type. It's not a thing. And they can point to examples that are relatively close and use them to understand the thing they're talking about. And that's what they do. But if you ask, is there a place where there's absolutely pristine, pure free trade? The answer is no. There are places like Hong Kong that long practice something very close, and others as well, but nothing perfect. In banking, there are places like those you mentioned, Scotland, Canada, and some others, that in many respects approach the ideal type of free banking, which is a banking system. It has to be defined again, right? It's a banking system where, apart from enforcing contracts as written between bankers and their customers, and otherwise enforcing ordinary laws that apply to all businesses, the government doesn't really enforce or interfere with the conduct of banks by limiting entry or by preventing them from having branches or by telling them what kind of investments they have to make or what are their stipulations, their contracts with their customers can or cannot include. They don't do any of that. They let the interest rates be free. So there's a whole bunch of things banks are allowed to do. Now, if you look, and very little, apart from cheating and absconding, that sort of thing, that they're not allowed to do. That governments won't let them do. Now, if we look around the world for examples, we don't find pristine ones. So, for example, in Canada, the government chartered all the banks and it exercised ultimate control on who could be a bank and who couldn't. There wasn't anything like a free incorporation law that applies to other industries. Every bank had to get a special legislative act. So that's not freedom. Scotland did allow free entry, so it's better in that respect. But if you keep looking at the details of these systems, you find that the Scottish system had some prohibitions and some departures from perfect freedom, like the fact that after 1765, the Scottish banks couldn't issue very small notes. They were prohibited. They had a maximum or minimum size banknote that they could issue. Anyway, the point is no pristine examples. But if we look at a whole bunch of systems and try to look at what the free components of those systems, we can piece together a picture using evidence from all these different systems of what a really free system would look like, and use that evidence as the basis for theorizing about such an ideal free banking system. And that's exactly what Larry and I did. First thing I ever published with Larry, which was part of my dissertation, was an essay called The Evolution of a Free Banking System. What we do there is rationally reconstruct, or if you like, reconstruct what a totally free market banking system would look like, how it would operate. We may have to justify our explanations. We can't just pick evidence we like and put it in. We have to say why we think this is evidence of what would happen under freedom, and this is not, etc. And we do. Maybe we don't do it perfectly, but we make a good college try. And that's the theory. That's the system the rest of my work theorizes about. So it's an ideal type system that it theorizes about. And, people who say, in a free market, there wouldn't be fractional reserves or whatever, make claims like that. They need to rationalize or defend or justify those claims in a manner like what Larry and I do, and they don't. They just say it.
I see.
And so we're not positing as free banking merely what we like. That is not what free banking is. Free banking is our best guess at what a free market banking system would have looked like if the government had stayed out of it all along. That's what we're trying to do.
That makes a lot of sense. And that I had read a lot of articles, in waiting to talk to you. And that's kind of what I had seen of the gist of it, right? So the free banking system, like an ideal free banking system, would have the market decide, like maybe there would be fractional reserve banks in that system, and there would also be fully reserved banks. People would be able to choose what was appropriate and for what, for different purposes as well. Like, for example, let's say if we take the example of a fully reserved bank, you might want to have your savings in there, your hard savings in there. And then you might want to have some of your other money, like your float, in a fractional reserve system, because doesn't also a fractional reserve system allow you to get a mortgage and things like that? Like, how could you get a mortgage, let's say, if it was a fully reserved system and that was all that existed?
So let's not confuse two things.
Okay.
There is a state, there's a lot you could prove without any evidence. You don't have to look around the past to say that a free banking system is one where people can choose. Of course, that is definitely part of it, a priori, if you like. What Larry and I are trying to do, what we think we do, is to show, using evidence, what kinds of arrangements people and banks together would choose based on actual experience, and in some cases simply the logic of profit maximization. So there's more meat on our depiction of free banking than the mere logic of the meaning of freedom. There's more to it than that. It is also empirically informed. And that empirical information tells us, among other things, that the overwhelming result of people's choices would tend to be banks that engage in fractional reserve banking.
And why is that? Why is that?
Because apparently people found the advantages of these arrangements, which, by the way, the examples, the empirical evidence we draw upon isn't from any banks or banking systems that had deposit insurance or other guarantees that would, as it were, slant the deck in favor of fractional reserves. We're not drawing on any of that. We're drawing on systems where there was no, we are very careful to not base any of our conclusions or speculations about what freedom would bring about on things that happen in the absence of complete freedom. All right. We're only looking where there's no government slanting the deck of any kind. And so we find overwhelmingly in country after country, it's almost the only game in town. And despite lack of government props. Now, the reason is that people like interest, and they like to have exchange media that are convenient, and they don't like to have to pay a lot for it. One obvious fact that has been overlooked by the critics of free banking is that you couldn't have a banknote that circulated from hand to hand, and that's much more convenient than gold, based on fractional reserves. You can't do that. It's not possible. Why? Well, 100% reserve institution has got to collect the storage fees and other fees. It's not earning any interest from the deposit, which is here a literal deposit it keeps on hand of gold coin, right?
Yes.
It's not earning anything from the deposit. It has to send a bill to the people who sold it storing. You can't do that with bearer notes or bearer certificates that circulate from hand to hand, because they, by their very nature, they're anonymous. Their holders are anonymous. So either the poor schmuck who puts the gold there in the first place pays for it forever after no longer having the claim to it, or you've had to figure out some way to keep track of who has those IOUs. I shouldn't call them that. They really are warehouse certificates in this case. You've got to be able to keep track of them so you can send them a bill. Now today
you're paying rent, basically.
Yeah, they have to pay the rent. Yeah. You couldn't do that then. Today, in theory, you could have some fancy thing where you can track them, but we worry about that, right? But anyway, in the past, it wasn't possible. So people who wanted to have more convenient exchange media basically had to truck with fractional reserve banks, especially when it was paper money. But when it wasn't paper, when it was deposits subject to check or other devices for transferring them, then they could earn interest if the bank made loans. And they like that too. They like that. People like interest. People like interest. We know from recent experience, people like interest even when they're really taking big risks to get a little bit more. They do it all the time.
Right.
So in this case, of course, they were also taking risks. As Adam Smith made clear in this very good discussion of this topic that everybody should read, they were taking more risk, but they were getting something in return. And banks were, of course, much riskier in the early days than in some of the, by 1800, those systems in many places had matured to the point where they could have very low reserve ratios. They had a lot of capital. But they could be very safe. They could be very safe because there was enough diversification of loans, etc. So the choice to make interest rather than store your money was not simply one that was for people who were, risk loving. Ultimately, they didn't have to like risk because the risk was very small.
And so this was something that Rothbard agreed with for a long time, right? And then suddenly, I think in the 80s, he turned around and said, no, actually, fractional reserve banking is no bueno.
I don't know about that. I actually think he was developing his opposition to fractional reserves much earlier.
Okay.
I couldn't put my finger on the earliest times when he did that, but I think that there are hints of it in some of his earlier pamphlets. But it's certainly true that at some point, if not all along, Rothbard convinced himself that fractional reserve banks were only so because they misled their customers, and because the courts ultimately allowed them to get away with it. And
I
the
see.
specific charge is that the money, the coins brought to the banks was brought to them for the purpose of safekeeping, that the bankers never had permission to treat it as their own and then, lend it. And that when they did so, they were essentially defrauding their customers. And it's only because the courts allowed them to get away with it and eventually developed legal doctrines that rationalized it, justified it, or sanctioned it, that banking has developed the way it has. And Rothbard even suggested that the mass of people had no idea what was going on, even in relatively recent times, if not still. And I know he did that because he argued seriously about needing to have, about the desirability of having what he called anti-fractional reserve bank vigilante squads, who would go around, with loudspeakers telling everybody, kind of Paul Revere-like, the banks are lending your money, the banks are lending your money. And the idea was to get everybody to start runs and force the banks to change their ways. And I mean, this was not said in jest. And it's all wrong. It's all completely wrong. It's wrong as a matter of history. It's wrong as a matter of legal doctrine. It's wrong as a matter of practical argumentation. And I could go on forever, and I have, about all these things. Just quickly, from the legal point of view, and I've written about this at length, it's an old doctrine went back to ancient times. I believe the original ideas were from Jewish law. But they were incorporated into Roman law and ultimately into Anglo-Saxon law. That when you bring coins to any kind of coin merchant, whether he's an exchange doing money exchange, or a bank, or anyone else, for deposit. The word is unfortunate, because what the principle says is that if you bring coins and they're loose, and you don't make specific instructions to the contrary, the law considers the coins to be the property of their possessor, which of course becomes the banker, not the person who passes them over the counter. And there were very practical reasons for this, but the basic one was that generally coins were fungible, and unless you could identify exactly who a coin belonged to, right, the specific coin, you couldn't treat it like other kinds of property or chattel, because the usual remedies couldn't be applied. The usual remedy is keep it back, not give a coin back. Give that coin back, right? And so on. There are a million reasons why this idea prevailed. But the corresponding ideal, which was a perfectly simple solution to the problem, was if you want to store your money, you bring it in a separate container and it's sealed, and the banker has to store that. And when you want it back, he gives you that very container and those very coins back. This is a very simple doctrine, right? So you brought loose coins, the ownership follows the coins. That is, the possessor of the coins is considered the bona fide owner of the coins, unless there's a way to prove otherwise, that those are really your coins, those specific coins are yours. And that doctrine is what informed all of modern banking, starting in England, but also in Rome before. and continues to do so. There was no point, despite what Rothbard says, where some stupid judge mucked things up by not understanding that the coins belonged to the depositor. That was the old or long established ancient doctrine.
So
and
when
Rothbard
you bring
creates a story where a certain judge in England, fouls up things, and that didn't happen. It never happened.
So when you bring your money to the bank, then you should know that this basically means that the bank owns your money while it's in their possession.
That's correct.
And so you're a creditor.
And it's still true today, right? By the way, the legal doctrines now, they've evolved. So the law that rationalizes this has changed, but the basic principle hasn't. So there are different legal arguments than there used to be. But it's still the case that when you go to a bank, let's say, just to make it concrete, I go to a bank, I hand them a suitcase of Federal Reserve notes, which would, of course, in practice set off all kinds of alarms, but forget about that. The minute I do, those become the banker's property. Now, this is where a lot of Austrians really confuse things. Does that mean I don't own anything anymore? No. It means I no longer own those paper notes, but I own something else. I've exchanged them. What have I gotten in return? I have the bank's IOU. I have a claim against the bank, which is a different financial asset. It's not the same asset. I have an IOU or a claim. I'm a creditor to the bank. Banker's my debtor. That's not the same as owning those paper notes. It's not the same as owning the money I brought. Now, but I own something, and I own something very valuable, because that claim it's a bundle of rights, including the right for demand deposits to get an equivalent, not the same money, but the equivalent sum of money back on demand when I ask for it. Now, the bank is not violating that contract merely because it doesn't keep all of the notes on hand. It isn't violating the contract because it might not have the money if I ask for it. It only violates the contract if I actually ask for it and it doesn't come up with it right then and there. And that's another confusion. The Austrians, I have people constantly saying to me, the bank is, couldn't pay, might not be able to pay, right? Okay, it might not be able to pay. That's called risk. That's not called violating a contract. That's called being a risky situation. That's not the same thing. Risk is a bad possibility exists. It's not a bad possibility has been realized. Those are different.
I see.
Yeah, those aren't the same thing. The other thing that I often have tossed at me is, people don't know that the bankers lend their money because we have polls and things that have been conducted that show they don't know that. If you look at most of these polls, what they say is something that, they might ask the person, when you put your money in a bank or you have a bank deposit, who owns your money? You or the banker? Well, that's not a good poll question.
Yeah, it's not an accurate question to
not an
describe
accurate
the
question.
circumstances.
The bank now owns the actual Federal Reserve money you gave it. But you own the claims on a bank, which are also money by the modern definition, right? We include those as part of the money supply. You still own money. You've traded one form of money that you used to own for another that you still own, that you now own. So you still own the money. The way you pose the question, in other words, can be very misleading. The person who thinks they still have money in the bank isn't necessarily confused about whether they still can go back and recover the same stuff they brought to the bank. They may not be confused about the fact that bankers use funds brought to them to make loans, not to put in storage. They may simply be speaking of the truth that they still own money exactly as much as they brought to the bank, without bothering to distinguish, they may not be, able to articulate the fact that the money they own is not the same money they brought to the bank. But that doesn't mean that the bank is pulling the wool over their eyes.
I see.
So
Yeah.
I don't trust these poll questions a bit. I don't think that they necessarily say what people think they say. I'll say one more thing about this, Kate.
Yeah, sure. Sure.
I've had by now roughly, I'd say, conservatively, I'll say 500,000 people tell me that the banks are pulling the wool over everyone's eyes. Now, 500,000 people, that's only the people I've heard this from. That's a lot of people. They all think that they're smarter than all those other people that they say are being fooled. That's chutzpah. I don't think the mass of people are more stupid. I'm putting this as politely as I can, than all the people who keep telling me this. I don't think there's any evidence for it. Instead, on the contrary, I think the people who are telling me this are pretty average Joes. So why should other average Joes be so much less intelligent than they are about this matter? I don't know.
I see what you mean. I really see what you mean. So it's why is there some secret?
It's not a very well kept secret if all these people know. So it begs the question to have this popular view, extremely popular, about something that nobody's supposed to know.
But I could see how at the same time, a lot of this is relative to people who are, pro Bitcoin and kind of in that part of the movement. And just because Bitcoin is so different, and there's this religious aspect to Bitcoin as well, and Bitcoiners in a way. Like there's this kind of belief that Bitcoin is kind of like this technology that's going to save humanity, right? Like there are very strong beliefs that people have about Bitcoin. And I think that ties into that whole thing about kind of thinking that there's a secret, right? Like it's the same kind of mentality in a sense. Is that possible?
It's possible, but I don't think that all Bitcoiners, and I'm not even sure most of them, well, first of all, not all of them are fanatics, right? We both know that.
Right.
Some
like I really like Bitcoin, and I think that it's a great thing. Yeah.
Some of them have this fanaticism that I find really, it really turns me off. But some of them don't. And then as for which of them think that fractional reserve banking is fraud and which ones don't, I think that's another division. And I'm not sure that those things all mesh up together. Are
mutually exclusive? Okay, I see.
Well, I'm not sure that the Bitcoiners who think fractional reserve banking is fraud are also necessarily the ones who are fanatical about it. It may include some who aren't fanatical. There may be some fanatical ones who don't think fractional reserve bank. So I think these different opinions cut across one another. But I don't know how. But I don't think it would be wise to suppose that even fanatical Bitcoiners all take the anti-fractional reserve view of things. I just not sure that's true at all.
Well, the only reason that I kind of thought of that, and it's because I'm still trying to untangle all of these things. They're all new to me to think about. And it appears that Bitcoin doesn't function as a fractional reserve kind of system. It's like if you are holding your Bitcoin in cold storage, like you own those Bitcoin. It's like having
fractional. Well, but that doesn't really mean much. As we said before, Bitcoin is a base money, analogous to gold or to Federal Reserve notes, a little bit of each, right? It's a base money, though. Now, base money isn't a bank money. So there's no question of fractional reserves. The question is, that is, there's no question of a Bitcoin or Bitcoins being fractional reserve money because they're not claimed to anything. So they don't need any reserves. They are the reserve money or potential reserve money. The question is, In a world where Bitcoin money became standard, Bitcoin becomes the standard-based money. It's only potential-based money now, right? It's not really widely used as money, no matter how many people claim otherwise. If it did, though, if there really were a Bitcoin standard where prices are quoted in Bitcoin, Bitcoin is the important fundamental medium of exchange, would there be such a thing as Bitcoin fractional reserve banks? That's the question.
Yeah.
And I've argued that I think there could be, for some of the same, not all of the same, some of the same reasons why fractional reserve banking evolved on the basis of silver and gold and other commodity standards. Not all of them, because there's a big difference. And this has been pointed out to me quite correctly. With gold, it really is cumbersome to move or carry gold coins, move gold around, physical gold. Whereas you can transfer Bitcoin relatively inexpensively. So claims against Bitcoin, fractionally backed, don't have the same big advantage relative to actual Bitcoin for transacting that claims to gold had relative to gold itself. And that's true. That's true. Still, such claims can actually have even lower transacting costs than Bitcoin. The Bitcoin isn't perfectly cheap to move around. We know that direct Bitcoin transfers can be slow, and we know that there are even problems with things like Lightning Network. That it has not solved all the problems of moving Bitcoin around really expeditiously and cheaply. And those who bother to try will find, if they don't know already, that you can move dollars around in an instant from one bank account to another, and it doesn't cost a thing for certain transactions. International is a little different. Now, the question, so there's already potential transactability advantages, some small ones, for Bitcoin-based bank promises that would give people some reason for liking those. But there's also, once again, interest payments. That, I think, remains the more important reason why I think Bitcoin fractional reserve banks would still have a place in a Bitcoin standard, would have a place, because people love interest, even when there's risk involved. And that isn't changing, because you cannot earn any interest on a Bitcoin. You can earn interest on a claim to Bitcoin at a fractional reserve Bitcoin bank, where when you put your money in the bank, most of it is lent out, and only reserves of it are kept for the purpose of meeting demands from people like you. And the rest, even the reserves today, could earn interest if they consist of balances at the Fed, which are nowadays earning modest rates of interest. But the other investments that the Bitcoin bank makes could earn considerably more. And that is where the temptation is going to come in, not for everybody. Let's allow that. It's much more likely there would be people who hodl their Bitcoin and don't use banks than hodl gold in the past instead of use banks. They were both. In the past, by the way, plenty of people held gold. What there wasn't were a lot of 100% reserve banks, so-called. But there were people who hodled gold, right? And that's going to be true for Bitcoin in the future. But there will be plenty of others, in my opinion, and now I'm speculating about the future, who use Bitcoin banks in the same way look at all the crazy cryptocurrency interest rate schemes out there, right? All these lending schemes. There's complicated things where there's interest, and some of which turn out to be very loosey-goosey. But the point is, banking on this old-fashioned principles with a Bitcoin foundation is a simple way to have Bitcoin stable coins or deposits or whatever that bear interest and are not necessarily terribly risky, and plenty of people are going to go for it.
Yeah, I mean, it kind of comes back to what you're saying when you and Larry White were discussing free banking, right? And writing about this and studying it. It's that it's not about necessarily the ideal scenario, but what things actually look like and what people actually choose. And
That's right. Yeah, this isn't
yeah,
there. When we're talking about, when I make these statements, I'm not making a statement about what I think is good. I'm not
right.
saying this is what
Moral
people ought to do.
judgments. Right, right, right.
I'm speculating about what I think people will do if they're free to choose. That's all I'm doing.
Yes.
Now, I can
Yes.
tell you whether I think that this is a wise choice or not, but why should you care? Why should anybody care? So now, I mean, but if you, but the one connection between the normative and the positive here is that our audience, the people ourselves and the people who are going to watch this, they like freedom and they think freedom is normatively a very good thing. And so it does matter then if I say I think in a free society in the future with a Bitcoin if it had a Bitcoin standard, people would be banking. Then if freedom is your thing, then you have to come to grips with that, right? If you think freedom is normatively good, well, then, okay,
People are
here's
free
one
to
of the
choose.
implications. Here's one of the implications that you should
Right.
consider.
Right.
What Rothbard did, to get back to him, what Rothbard did was he used his own he had different normative positions. One was like ours, freedom is a good thing. We like to have people be free. The other was not so much, the other was that fractional reserve banking was bad because it can cause business cycles. I think Rothbard believed both things, right? Freedom is good, fractional reserve banking was bad. And there's nothing wrong with that. I don't think fractional reserve banking necessarily causes business cycles, but let's suppose it does. Where Rothbard went wrong was in trying to resolve this problem, this contradiction, if you like, that one thing that he liked might lead to something that he didn't like, by saying that fractional reserve banking isn't really part of economic freedom. It's not really implied. And he concocted, to be, I'm sorry, I have to say it, he concocted a bunch of legal history and banking history to do that. He said, I like freedom. I don't like fractional reserve banking because I think it's bad. I know we're losing signal because we're approaching 5 o'clock.
Yeah.
And therefore, I want to be able to argue that in a free society, we won't have fractional reserves. And I'm going to do that by saying that the only reason we do have them is because people cheated and lied and courts put up with it and all that.
Well, George Selgin, as you said, you are in Spain. It is approaching tapas hour and happy hour, and time for you to go and enjoy that beautiful
the
place.
internet here gets really flaky as you get close to 5 o'clock, as we've discovered the hard, and as your audience is probably observing now.
Yeah, it's not so bad though, but I think it's a good place to wrap it. I mean, we could go down so many rabbit holes, and I know that we went deeper in some subjects and touched on the surface of others, but I'd love to speak with you more in the future about these things. It's really been a pleasure having you on.
Thanks, Kate. Anytime you want to climb down a rabbit hole with me, I'm happy to do so with you.
Well, I hope that it could be, in Spain, listening to some flamenco guitar on a patio in real life. I mean, that would be a nice place to go down a rabbit hole.
Yeah.
Well, thank you so much.
If you are game. Yeah. You're very welcome, Kate. Talk to you again soon.
We'll talk again soon. Thanks, George.